Hello traders. In a trading journey, you will encounter many traders who claim that they rely on pure price action to make their trading decisions. As you can see on this chart, we have marked a number of areas: resistance area, support level, support area, higher highs and higher lows, among others, as we intend to take a look at price action. Price action is one of the most commonly used and reliable technical tools or technical analysis tools by Forex traders when they are analyzing the market or the charts before taking their trading positions. At the same time, we will also be taking a perspective on what a price action trader would have to factor when they are making trading decisions in a case where they have decided that they'll be trading the crude oil as their trading asset in such and such a given deal. We begin by mentioning that price action refers to the movement of a security's price on a chart of a given period of time. The time may vary from minutes to hours to weeks and months and so forth and so on, but this usually depends on a given trader and the strategies that they are employing to trade the forex markets. Typically, traders who use price action focus on raw price data such as candlestick patterns, support and resistance levels, chart patterns, and other formations before or as they make their trading decisions. Let us look at how price action is applied and the critical areas to consider when making trading decisions, utilizing the price action to trade the forex markets. We see that some of the areas that a trader will have to consider include candlestick patterns, support and resistance levels, trend analysis, engulfing patterns, chart patterns, and pin pairs, among others, as we will see. So let's look at candlestick patterns. We note that when using candlestick patterns to trade, market participants usually analyze candlestick patterns so as to gain insight into the sentiment of the market, or rather, into the direction that the market might be taking, depending with historical patterns, as we have seen. Some of the common candlestick patterns include doji, engulfing patterns, and pin bars. These patterns usually signal potential reversals, continuations, or indecisions in the market. Support and resistance are other levels that are highly employed by forex traders to make their trading decisions. These are areas where the price has historically had a difficult time moving beyond and are usually observable in various trading or in various time frames, but are often more pronounced in higher time frames than lower time frames. What this means is that while resistance and support levels, traders will realize that prices do not just go past those levels easily. It's because in most cases, traders who are long on a given currency pair will basically wait to take their positions at the support levels, while those that are short or are waiting to short the pair will often do so at the resistance levels. As such, if you had taken a position or if you are observing the market, you realize that the market doesn't go easily past that level. So the other thing that traders do is to perform a trend analysis. Traders use price action to identify trends and trend reversals. Trends are usually characterized by higher highs and higher lows in an uptrend and lower highs and lower lows in a downtrend. Price action traders may look for trend lines and chart patterns that will help them to identify the trend direction. Another aspect that is of core significance when trading price action are usually the chart patterns. Various chart patterns such as head and shoulders, triangles, and rectangles can be identified through price action analysis. These patterns are believed to provide insights into potential future price movements based on historical price behaviors. As such, traders can use the triangles, head and shoulders to be able to determine the kind of position they should be taking depending with the command of such chart patterns. Another area that is critical when performing analysis using price action is engulfing patterns. And we mentioned that an engulfing pattern occurs when a candlestick completely engulfs the previous candlestick. Usually, there are bullish engulfing patterns and bearish engulfing patterns that are often clearly visible on trading charts. Bullish engulfing patterns usually suggest potential upward movement, while the bearish ones suggest potential downward movement. So, if a trader was taking a trade and they have seen a bullish engulfing candle, they probably should see that as a confirmation that the market is likely to trend upward and therefore take a long position. Then we see, finally, we look at pin bars. And we will mention that pin bars have a small body and a long tail or wick. A bullish pin bar at a support level usually indicates a potential reversal to the upside. On the other hand, a bearish pin bar at a resistance level can often signal a potential reversal to the downside. So if you are taking a trend, it would mean that you would be shorting a pair once you have seen a bearish pin bar. Finally, risk management is another aspect that price action traders put into consideration, or rather use the price action to determine how they are going to manage their trends. You see that price action traders often incorporate effective risk management techniques, including placing stop loss orders based on recent price action levels. So now, let us take a look on how a trader might behave or might perform their analysis if they were trading US oil. By US oil typically means West Texas Intermediate crude oil. So, what if should a trader decide that they are going to use the strategy of price action to trade US oil? The first thing they would do is to identify the trend and support resistance. Then they would proceed to find the chart patterns, perform a trend analysis, and then find out whether there are any breakout confirmations, and finally manage their risk appropriately, as we have seen by seeing the potential exit, stop loss, exit, entry, exit, and stop loss levels. The final thing, when they have taken their trade, we will see that they should continuously monitor the price action for any potential reversals so that the market does not suddenly go against them and they are left making huge losses, and particularly if they had not had stop loss orders on their trends. When trading When trading, it is important to always bear in mind that price action trading requires a deep understanding of market dynamics and ability to interpret price movement effectively. At the same time, while price action analysis can be powerful, it is crucial to consider the factors including fundamental developments, economic indicators, and geopolitical events that often influence movement of prices, such as oil prices in this case. Price action is most effective when used together with other trading or together with an understanding of other factors that affect the market. Thank you for watching. As usual, let us meet in our next video that will be uploading in the coming soon.